Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the second part on the series on the financial accounting ratios. Hope you will like, share and subscribe our channel. Financial accounting ratios 2, the second part. The balance sheet is a static statement, a picture, and the profit and loss account is a dynamic statement, a film. When you are able to see the interrelationships between the balance sheet and the profit and loss account, you gain even more insight into how the company develops financially. Ratios offers you this insight. That's why the key ratios are presented at a glance. Can you cope with them? These ratios are expressed as decimal value such as 0.10 or given as an equivalent percent value such as 10%. Some ratios are usually quoted as percentages, especially ratios that are usually or always less than 1, such as earnings ratio, while others are usually quoted as decimal numbers, especially ratios that are usually more than 1, such as profit earnings ratio. These latter are also called as multiples. The 5 standard financial accounting ratios: liquidity ratio, profitability ratio, solvency ratio, turnover ratio, earnings ratio. Liquidity ratio. Liquidity is the lifeblood of a business. If a company doesn't have enough liquid assets, that is, things it can convert to cash quickly, like marketable securities, accounts receivable, and inventory, to meet its current financial obligations, it might need to declare bankruptcy. Liquidity ratios provides a sense of a company's financial health. Therefore, it determines how quickly a company can convert the assets to cash and use them for meeting the dues that arises in the short term. Profitability ratio. Profitability ratios are a group of financial indicators that are used to evaluate a company's capacity to create earnings compared to its sales, operational costs, balance sheet assets, or shareholders' equity over time. The ratios, although generally the higher the more favorable, provides a more clear idea of the company's standing when compared with competing companies' own historical figures or industry average. Profitability ratios measure the company's use of its assets and control of its expenses to generate an acceptable rate of return. Solvency ratio. In general, solvent means to dissolve in other substance. Solvency in finance or business is the degree to which the current assets of an individual or entity exceed the current liabilities of that individual or entity. Solvency can also be described as the ability of a corporation to meet its long-term fixed expenses and to accomplish long-term expansion and growth. Indicates how companies use debt. While debt can help a company get a higher rate of return on its cash investment, too much debt increases the probability of a bankruptcy. Solvency ratios are also known as debt ratios or leverage ratios. Turnover ratio. The turnover means the time taken to turn over or convert a specific resource of the company and get cash. This assesses a company's operating efficiency. Operating efficiency is the time a company takes to convert its inventory into sales and repay its suppliers using the sales proceeds. This cycle of converting inventory to sales and paying to suppliers is called cash conversion cycle. Converting inventory to sales quickly also helps companies receive revenue sooner and avoid borrowing money to run their operating expenses. Efficiency ratio, also known as the market ratio. Hence, through this ratio, the investor measures the market is compatible or not in relation to the company's stock and also the pricing and issuing of the stocks in the open market, as these are concerned with the rate of return on investments for shareholders or stakeholders and with the relationship between return and the value of an investment in company's share. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel, Accounts and Finance with FARSK. Thank you. Have a great day.